and for their quantitative easing. And what they basically said is that previously they had stated that if unemployment got to the 6.5% level, that they would consider start raising interest rates. And they sort of backed away from that statement because right now there's a problem going on with the unemployment rate. And in fact, what's happening is that the participation rate, which is the number of people actually in the economy that are actively seeking jobs, is dropping. In fact, it's dropped down to, I think it's like a 1980s level. So there are fewer and fewer people looking for work. And therefore, because fewer people are looking for work, it's artificially dropping the number of people who are, essentially unemployed. So the unemployment rate seems to be dropping and going down, but it's simply because people have given up looking for work. And so that's sort of distorted what's going on in the economy. And so they backed away from the statement that, gee, we're going to think about starting to raise rates when the unemployment rate gets to 6.5, because in fact, in January, it reached the level of 6.6%. And as we got closer to that, they sort of realized that the economy is doing well, but it's still not producing a lot of jobs, and in fact, people are becoming discouraged. And in February, it actually jumped up as more people sort of went back into the labor force, and it went up to 6.7%. And people went back in and started looking for work in February because they became more encouraged. They thought the economy was doing a little bit better, and people started to come back into the job market and look for work. So even though the unemployment went up in February from January, the Federal Reserve looked at it as a positive sign because more people were coming back into work.
Maybe the unemployment benefits were being non-renewed.
Well, and that's part of it too. I mean, what they're thinking is there have been so many people into these long-term unemployment benefits, and as they fall off the rolls, there then becomes an incentive for those people to come back into the workforce.
Right.
And that's changing that dynamic a little bit too. But if we could go on and just start looking at some of our graphs. We put in some of the...
Tab 2.
It's actually under the end of tab 1, right before tab 2. And I just kind of wanted to give you a quick overview of some of the activity. As you can see on the first chart, federal funds rate really hasn't changed for quite a number of years. But what has changed is, and the federal funds rate really controls the short end of the marketplace, but what has changed is the Fed has decided to cut back on their quantitative easing, which really controls longer term rates. And they were buying $85 billion in trade, a combination of treasuries and mortgage-backed securities every month for about the last year and a half. So it's unbelievable how the Fed's balance sheet has actually ballooned over that time because of buying all these securities. In December, it was the first real change in a year and a half. They decided to cut back that $85 billion. They cut it back $10 billion to $75 billion a month. But they're still buying a lot of securities. And in January, they cut that back another $10 billion down to $55 billion a month. So what they're trying to do is, this is what they're saying tapering. They're trying to get out of the business of buying all these longer-term securities, which is keeping the mortgage rates down. And they're doing that because the housing market's starting to come back. You even said that here, and I know in the San Francisco area, the housing prices are back up to prices where they were before the recession took place. So housing market's getting better, and therefore they can allow mortgage rates to start to rise a little bit. And as they start cutting back on this quantitative easing, they're actually buying longer-term securities. That will allow longer-term rates to start to rise. And we're going to see that in the next chart, where it says the historical yield curve. The red line is where interest rates were across the maturity spectrum from 3 months out to 10 years. That's where we were a year ago. And you can see longer-term rates much lower. Now, with the quantitative easing starting to reduce, longer-term rates are beginning to rise. So that yield curve is getting steeper and steeper. In other words, longer-term maturities are starting to pay a little bit more in terms of return. Just to give you an idea, a year ago, the 2-year Treasury was paying 25 basis points, which is 1/4 of 1%. 1 basis point is 1/100 of 1%. Rates are so low that we're measuring them down in the 1/100ths of 1% level. And so a year ago, the 2-year treasury was paying 1/4 of 1%. Today, it's paying 38 basis points. So that's about a 50% increase in the 2-year treasury over the last year. So rates have risen a little bit. 50% sounds like a lot. 13/100ths of a percent is not a tremendous amount. But in the 5-year area, 1 year ago, 5-year securities were paying 85 basis points, and today they're paying 171 basis points. So almost 1.75%. So that's doubled. So the 5-year
Where's
rates
your
have
5
doubled.
years?
What's that?
You have a 5-year chart?
There's not a 5-year chart, but you can see the 5-year on the bottom part of this chart, and you can see how much it's increased over that time period.
Oh, okay, from 0.75 up to 1.5.
Exactly. Yeah, it's actually about 1.7 today. So these charts were actually made in early February. So, I mean, the 5-year has doubled in terms of performance. The 2-year is up 50%. And as you can see, the further you go out in terms of maturity, the more the rates have risen. Unfortunately, for most of our clients, we're keeping those funds relatively short in anticipation of perhaps some higher rates in the future. We don't want to go out too long and lock in at the bottom of the interest rate cycle. But we don't want to keep it too short either, because overnight funds are paying very little. I mean, overnight funds are paying less than 1/4 of 1%. So, and as we can see, if you flip to the next page, just a quick update on the GDP, or the gross domestic product. Last year was a slower year than they thought it was going to be. In 2012, GDP was 2.8%. But last year, in 2013, it was only 1.9%. Down a full percentage point from the year before. And in 2014...
That looks to me like it. Oh, you're right, okay, 1.9, okay.
Yeah, it just dropped down. You can see it dropping down in that piece below.
Wasn't that dropping down below 4%? A GDP chart, December 13?
Yeah, it's not, again, that's at one point, we're talking about the average for the entire period for that year.
Okay.
And it did, in fact, increase up to over 3% in the fourth quarter. So the fourth quarter turned out to be a good quarter.
Oh, the average is 1.
Yeah, but the average is 1.9. And that's a lot better than, it's good, and it would be great if you were in Europe, who are looking at, 0.3% sort of growth in GDP. It would look great. But the 1.9% growth for 2013 was still below even where we were growing in 2012. They're anticipating 14 to be 2.9%. We'll see. They had called for 13 to be 2.9% as well, and they had to adjust it down as the economy slowed all year. The primary driver on why the GDP slowed in 2013, though, was the anticipation of higher rates and the anticipation of this taper in the quantitative easing. And as you saw mortgage rates rise, housing starts and housing purchases began to slow about mid-year. And that really put a real drag on the economy for 2013. So we're hoping we're past that, and that the GDP is going to look up for 2014. Just to say, I'm going to skip on, the only thing I want to point out in the supply chart is that you see the bright blue line in the second graph down there on the Institute of Supply Management, which measures the manufacturing activity. The snow in the east and the upper Midwest actually slowed down. The economy is so fragile that having extra snow in the east and upper Midwest actually slowed the economy significantly in both December and January. So it was really a drag on the economy. So that's how fragile the economy still is across the country.
It was a little more than extra snow.
Yeah, it was a 10-year high in snow. It was like the biggest snow in a decade, but it did slow the economy. It did.
And it floods in the spring.
Well, it turns out people don't like to shop for cars when there's a lot of snow outside. So, and when it's, bitterly cold. And I guess they had, bitterly cold weather along with the snow. So,
This consumer price index,
yes,
I had a discussion on this last night. My understanding is they dropped out the energy and the food, is that true?
only on the core, that's core CPI, as opposed to, these are the headline numbers, and then they also do an adjustment where they back out food and energy because no one eats or drives a car. That's what they look at core. They actually drop it out to core because they say food and energy are too volatile.
What numbers are you showing here?
We are showing the headline numbers as opposed to the core numbers.
So they're in here.
Yes, absolutely, food
Both
and energy.
and food.
Food and energy are both included in this. I think the core numbers to me seem a little artificial because people do eat and they do drive cars and they do use energy. So to say, well, gee, we only want to look at the core numbers because they're less volatile.
What is the core number? Do you have the core number?
I actually have that in my briefcase here. Well, I think I left it in the car. I know that the core numbers for the CPI, I've got it here. Let me just give you this and then I'll do from memory the core numbers. The target for the Federal Reserve is 2%. That's what they're looking for. And when they made that move in December, they said, if inflation, we're not going to raise interest rates if inflation is significantly below our target rate. It's at 2% is their target rate. And you say, well, why is inflation good? Because anyone who's been around since the 70s have said, gee, we don't like inflation. Inflation's bad. Turns out that in the economy, a little bit of inflation is good. I liken it to a sailboat where it has a little bit of wind. And that inflation makes the economy move forward. So because people say, gee, houses are going to go up or cars are going to go up next year, therefore I'm going to buy it now because it's going to be more expensive next year. So there's a little bit of anticipation of people saying, it's probably just as good to do it now. Imagine the opposite. If it was deflation and cars and houses were going to get cheaper next year, do you think you would buy one now or wait till next year? You would probably wait till next year. That's why deflation hurt Japan for that lost decade. Now, to get back to your question, year over year, the producer price index, which is shown on here, is 1.2% year over year. So that was basically for 2013. And then the consumer price index year over year was 1.6%. Now, I know the CPI X food and energy, the consumer price index X food and energy, was actually up only 1.2%. So energy costs and food costs were up a little bit more than general costs last year. But I really like looking at the headline numbers as opposed to just the core numbers because people are, they're buying food and they're buying energy. And if your food costs go up, that's part of your increased costs. So you can see at 1.6, even the consumer price index at 1.6 is still below the Fed's target rate of 2%. 2% is the ideal, what the Fed has said is the ideal sort of 2% to 2.5% is where they want to see it to make the economy move at the ideal speed. So it's moving slowly. And in fact,
And if it's under there, they will keep doing the quantitative easing?
they will probably not do quantitative easing, but they will not raise the federal funds rate. So they're going to keep that short rate very low.
As long as they're underneath their target, they
As
will
long
not
as-
increase it.
That's what they've said. That's exactly what they said in their statement in December. They said, as long as we're not seeing any inflation, we're going to keep that Fed funds rate low. Why? Because that inflation helps to move the economy forward. Right now, Europe's inflation is running about 0.8%. So they're very concerned in Europe about having an inflationary trap, which is what they had in Japan when they had the lost decade. Deflation. It's a deflationary trap, that's right. So they're very concerned about that in Europe. In fact, they're talking about starting some quantitative easing of their own, buying securities in Europe to try and see if they can boost the inflation rate. Germany, of course, is against that due to the things that happened during the war with hyperinflation after World War
Well,
I.
I'm still of that mindset. I gotta get over it one of these days, but.
It is, if you
Well, when
were
you
around
pump 85 million
85,
in a month, it seems to me we should have inflation to 8 to 10%.
it should. The difference is, because they're doing all these purchases and they're putting all this money into the system, this is kind of economic sideline, but this is like, there's a thing, we all learned in economics when I took it 30-some years ago. There was a thing called the multiplier, it's like the multiplier effect. It has it's the speed or the velocity of money. And so you put money into the system and you think this velocity is constant and therefore the use of money is going to come out and we're going to see inflation. However, it turns out velocity isn't necessarily constant, which they thought it was. It actually has been decreasing. So what's happening is the Fed's pumping money into the system, the banks aren't lending it out, and they're just putting it onto their balance sheet because they're not making any loans. So they can pump all this money in the system and it's not inflationary if the banks don't lend it out. And that's what's happening.
So it's just sitting in the bank?
It's sitting in the banks and it goes on their balance sheet, but that's why if you look at your CD rates at banks or you look at what you're getting paid on your money market fund at bank, that's why they're not paying you anything on it. Because they've got as much money as they want. They have no need for that fund, so they're not going to pay you anything on it. So all that money is sitting in the banking system and it's not coming back into the economy.
Keep moving.
Sure. Sorry for the side.
No, I appreciate it.
And that's what's happening to it. So, we already talked about the unemployment rate a little bit, and it did jump up a little bit last month as more people came back into the economy. Retail sales were soft in January. They were pretty strong. They were 3.6% for 2013. In January, they only grew at a rate of 2.6%. But I think as we move into the further and further into the recovery, you're going to see retail sales somewhat mirror that GDP growth. And if we expect 3% GDP growth, we're going to see retail sales that's going to be coming in this part of the economy somewhere around that level. So I think that that's not, even at 2.6 is not a bad number for retail sales. Housing, you see right at the end, there's a little dip in housing in the latter half of 13, and that comes from the talk of reducing that quantitative easing. And that pushing interest rates up for mortgages, all of a sudden, as you would think, interest rates go up for mortgages, all of a sudden people are less willing to buy housing because it becomes essentially less affordable. And so some of the new home sales drop down. And so that's pretty much the economic update. The economy is growing, it continues to grow. We're in, the fourth year of the recovery or fifth year of the recovery. That's good. But it's not growing strongly. And in fact, something even like a snowstorm or poor, snowy, cold weather can throw the economy off. And it did. It threw it and slowed it down in both December and January. So it's a recovery. It's moving in the right direction, but it's not necessarily super strong. And so the Federal Reserve is very likely to keep the interest rates relatively low, particularly on the short end, even though they're reducing this quantitative easing. And they should be done and doing no more quantitative easing by the end of this year. They're going to reduce it every meeting, $10 billion reduction at every meeting until they're at zero. But that doesn't mean, and the Fed said this in December, there's a decoupling. It doesn't mean all of a sudden as soon as they're done with the long-term quantitative easing, they're going to raise rates. They're not. They're going to tie that raising of the Fed's funds rate to that inflationary target. And as long as we continue to be below that inflationary target, and we have been for years below the inflationary target, it's very unlikely that they're going to start to raise rates. So that's sort of the summary. Let's move on to tab 2, and we can look at the portfolio. And we're measuring in the first part under amortized cost, the city's portfolio or the town's portfolio versus the one-year treasury. and the 2-year treasury. The portfolio has an average maturity of about 1 year, so it's just over 1 year, so it's somewhere between the 1 year and the 2-year treasury. But our performance has been up around the 2-year treasury area, even though our maturity has been closer to 1 year. So the performance has been good. Fair value performance, unlike amortized cost performance is like the yield performance. It's really the income that we're getting from the bonds. Fair value not only looks at the income, it says how the price of the bond's been moving. That tends to be very volatile. As you can see right here, it's hard to get much information from that because the market, quite frankly, bounces back and forth just like the stock market does. And the fair value return can be very challenging to use, particularly if you're using it for budgetary purposes. Yes.
We all understand historical cost, what we paid for something.
Mhm.
We all understand what it's worth today, fair value. I don't quite get how you do this amortized cost calculation.
The amortized cost calculation takes all of the income that the bonds create, and that includes the interest income, plus if we bought anything at a discount or a premium, which means we bought it, 95 cents on the dollar versus maybe a 105, which is a premium if we buy a bond. And it takes those adjustments, those accretions or amortizations, also into the calculation. If we actually sold a bond at a profit, like a gain, it takes that into the calculation. And if we sold it at a loss, it takes that into the calculation. But what it does ignore is the actual price movement on the bonds, which is really captured in that fair value. It assumes those bonds are all held at amortized cost. So if I'm doing the calculation, I'm taking all the income that the bond produces during a certain period, say a month, and I'm taking it over the historical cost, average historical cost of the portfolio for that same period of time. So I'm looking at a month and I'm saying, okay, there was $10 million in the portfolio, and here's how much income I have, divide that by this, and that gives you the performance. And generally, we annualize that performance and say, if it was 1 month, and we annualize it so that you can look at it and say, gee, that was such and such percent. Just like...
How often are you doing transactions other than maturity?
Well, we do very few transactions other than at maturity. I mean, most of these bonds are being held to maturity.
So most of these adjustments have to do with when you're buying below par value, or buying a zero coupon.
Or buying at a premium and that sort of thing. Yeah, we don't do a lot of trading because the idea of this portfolio is not to try and capture capital gains, by selling it high or, buying it low and trading it back and forth. That's not what we're trying to do. What we're trying to do with this portfolio is to get good bonds that are paying us income, and we're living off the income. And that's what we're really trying to do. We're not trying to trade back and forth for value. I think that's very difficult to do. The idea is to get the money invested and get a good performance on it. And then generally we hold to maturity unless there's a reason. Sometimes you might look at it and say, gee, we might be able to sell this early and then reinvest into another security that's paying a little higher rate of return. We might look at it then. But in general, since I've been working with Robert, I don't think we've sold one bond prior to maturity.
So of the $24 billion that you guys manage, is it all clients like this where you're talking about preservation of capital and fixed income type yields that are very low?
Generally, right? And most of our certainly all of our public sector portfolios are like that. But we do manage some for insurance companies, some for banks. They are generally preservation for principal as well. They're really not involved in the trading because they really want the income from the securities as well, just like the bank does. I mean, I'm just trying to think if there's any of the portfolios that we manage that are more.
I was on the board of a small insurance company for many, many years, and our investments did much better than these historically.
Yeah, absolutely. And
These are all treasuries, aren't they?
well, there are treasuries and agencies and some corporate securities.
Any munis?
There's no munis in there, but that is something that, I think it's in the portfolio, in the policy now, isn't it, Robert? We'll have to go back and see if we put that in.
We can buy the purchase bond.
I don't think so.
Where is the policy? Is it
Corporate
in
policy is under
tab 6?
6.
Well, we did modify, but without you being here, so we were a little bit, a loose cannon, but.
No. It doesn't allow for munis. That is something that's permitted under statute, however. I will say though, yeah,
We don't pay taxes on that.
right,
So why would
this is the problem. Now, some public entities do issue taxable bonds now. It's becoming much more popular for public entities to issue taxable bonds.
Is that right?
Oh, absolutely.
Why would they, how did they do that?
I tell you what, they just do it. They issue taxable bonds and taxable securities. I looked at one last week for one of our portfolios. It was a Pasadena School District bond. We didn't end up buying it, but it was a taxable bond. And quite a few public entities, I have to say on the municipal finance side, I'm not sure why they're doing it or for what purposes, but it's becoming much more popular to issue taxable
Well,
bonds.
how can they issue? They're a government entity. By definition, they're tax-free.
I don't know how they get, I don't know that part of it, but
Well,
they
they
do
get a
issue
higher
taxable
yield.
bonds.
They
But
don't,
they pay a higher yield.
they pay out.
They pay a higher yield, yeah.
Well,
Because-
there are some kinds of things, if it's for a public facility, the tax code gets very, you probably know what I do about it, it's very variegated
Well,
about
special districts that are
that kind of stuff.
proprietary type activities. They could get revenue bonds. Is it
This
revenue
was a school district bond that I was looking at, it was a taxable bond.
Somebody's not confused. Okay, let's go on. I'm sorry.
No, it's okay. Of course, boy, I tell you what, I've been doing this a long time too. I tell you, when I first started 30 years ago, we looked at, we could buy 2-year farm credits paying 11%. But that, unfortunately, that's not the market we are in now. And even as little as 5 years ago, overnight investments were paying 5%, and 2-year treasuries were paying 5%. It's a different world right now. I mean,
I was on a board 5 years ago, they didn't want to, I wanted to build a ladder
yeah.
at 5%.
Yeah.
So let's not do that, rates are gonna go up. I said.
Oh, man.
They wanted me down.
That was a wrong call.
Oh, man.
And you know what happened 5 years ago is that overnight funds, Lake, for instance, was paying probably 5.30. And you could get 4 or 5 year treasuries, they were paying 4.80. So you could lock in into treasuries at 4.80, but you had to give up 50 or 60 basis points to go in and lock in those treasuries. And a lot of boards didn't do that. They said, well, we're just gonna keep it in Lake because, it's paying 60 basis points more. And what happened is, of course, Lake went down as we went into recession and interest rates down, and they still have those 4.80s into the portfolio today. But
I was trying to find out, that was a phone call, what the rate went today on the California bonds, they sold them today. I didn't find out.
yeah, it's, right now, if you take a look at the portfolio and turn to, tab 2, and it'll say, at the top, it'll say amortized cost summary, activity and performance summary, it'll look like this. Be careful, there's 2 of them, one's on an amortized cost basis and the next one's on a fair value basis.
Which one should we do?
Let's look at the amortized cost, I think that's probably most germane to you.
The fifth page
It's
ends.
still in tab 2.
Yeah,
Yeah.
tab 2, fifth page.
And it'll say book page number 3 on the lower left.
Okay.
If I can take her to the lower right-hand box where it says the summary of account, cost basis return, period. The first one is for the total portfolio, and we actually manage only the cash portion. So we manage about the $10 billion.
10 million.
10 million. Yeah, I know. It's that $10 million piece that's the term piece, and the other piece is actually the cash piece. And that's, I believe, in Leif, right? So, Leif right now, just to give you an idea, is paying.
What's LAKE stand for the audience?
Local
It is
agency investment.
Investment fund.
Local Agency
Agency
Investment Fund, run by the state of California.
Right, absolutely.
All right.
Right now, it's paying 23 basis points. The man from Leif was at the the conference for the CSMFO, and he thinks it's going to go down from there. And what's happening is short-term rates are actually going down at the same time long-term rates are going up. So the curve's getting a little bit steeper.
What's the maturity of like?
Well, the actual funds are about 185 days on the actual term of the funds, but you can get your money, the state guarantees you can get your money out the next day.
Yeah.
So it's overnight availability, although effectively, the weighted average maturity makes it effectively a short bond fund. About a 6-month maturity on the average investment.
0.23.
0.23 is what it's
I
paying.
kind of wonder if we build a ladder, you don't really have to be able to call all 10 million of this overnight.
That's right, and that's effectively what we've done, is built the ladder out over a period of time. And so that, we've got some different investments maturing in all sorts of different times. And so there is some liquidity within the term piece of the portfolio as well. If you'll turn to this page with the pie chart.
3 pages beyond survey.
Go page 5.
It'll say page 5 on the bottom left-hand corner. You'll see that right now, of the total portfolio, this is from February, it's about 21 million. Just over 50% of the portfolio is in cash,
And that's
Yeah.
late.
and that's LAIF. So, and that's, at that time it was paying 24 basis points, right now it's paying about 23, and we think it's going to drop down towards 20.
Does that include the money in the Wells Fargo Bank, or is that a separate number? That's a separate number, right?
The Wells Fargo is not in this portion.
Right.
Yeah.
Okay.
And the rest of the portfolio, the other 48% shown here, is primarily in 38% or 37% of it's in U.S. instrumentalities. That's Fannie Mae, Freddie Mac, farm credits, home loan banks, federal home loan. So that's distributed amongst those different instrumentalities. Small portion in treasuries. I'd love to see you have a little bit more in treasuries. Right now, it's a little tough because treasuries really aren't paying anything, so.
What's the maturity on these? The treasuries?
The maturity on the treasuries, all the general durations are on the side here is on a summary basis, if you look in the far right-hand corner. But all of the holdings are underneath here. The treasuries actually mature in July of 2016.
Where are you? Where is it?
That's under the holdings page, that's this page right here.
Page 7.
So,
Oh, it seems like a lot, 190 days. I mean,
if you look at if you look at this maturity distribution page, you got a high concentration underneath.
Do we need to do that?
Well, I mean, I have to say, that's primarily the LAIF portion. Robert was going to know your cash flows a lot better than I am. I don't know all of your expenditures, if you've got a big project going on, or if you've got something happening that you might need funds for. And, certainly, I mean, if you have an expenditure, you want to hit those targets. I don't know that cash flow portion. I think that there may be, and Robert can tell me better, some funds that are available on an overnight basis that might, we might be able to put out into some higher earning assets.
So, I had the exact same thought Alan did when I reviewed this stuff yesterday. Do we blame Robert and George if we, I'm not being facetious. I mean, is it Robert and George that are making the call that we're all in, essentially in extremely short-term paper, or do we blame you?
Well, we don't call what percentage goes into the short-term paper. We're trying to work together, and these guys know their cash flow better. I mean, they know the cash flow the best.
And the thing is, we can put things, the longest we can go out is 5 years in
I understand that.
And the reason is, sometimes the liquidity is an issue. Late, we have it, we put our money in late, so if we need it, if there's an expenditure, 2 million, we need it, they can wire us that money. Because in our operating account, we don't keep that amount in our operating account for everything.
That's
The
Wells
other-
Fargo.
Right, we don't keep that much amount in our operating account, because we wanna invest it. The other thing too is there's not that many investment tools for us to really get into without actually playing the market.
Yeah.
And so that's why with our investment policy, we brought it to, we bring it every year to look at it and see what we can invest in. You know, we have US instrumentalities is one, medium-term notes is one. We're starting to diversify and get into medium-term notes, getting
Yeah.
into the corporate sector. And so to build that,
I don't mean to put you on the defensive. You haven't been here that long.
No.
So I can't put all the blame on you or George.
no. But
That's not my
rates are
point. I
down.
just think this is my guess is, this is a very poor distribution of our assets in terms of the dating. And, I mean, I'd have to know more, I'd have to go back and look, but you've got a whole year's budget. You got over $10 million invested in stuff that's gonna come
Well, you got
mature.
another 2 million in capital expenditures. 5
I,
million in the budget, what's the budget?
No, I'm not trying to break down the budget, I'm just saying it costs us $10 million to run the city, and we've got 21 million invested, and we have a big portion of the amount above a budget, an annual budget, invested in very short-term paper. It strikes me as strange. At least strange.
Well, it's not because for
foolish.
liquidity reasons. That's why we have it in late. And like was discussed, late, a couple years ago was 5%.
Right.
I mean, everybody had their money in late because it was easily liquid. And it was, you're getting the highest rates than having to deal with investing in treasury bills, investing in corporate bonds. Late was safer, you were getting just as high a return and not having to deal with the.
Well, you
risk.
gotta recognize that the cities and counties around here lost $155 billion less than 5 years ago, so they're paranoid, just generally speaking.
and I have to say, Robert has moved more money out into term investments in particularly in the last couple of months than had ever been done before. So that portfolio